All right, so today we're going to talk about monetary policy, which are actions taken by the Federal Reserve. So, as you remember, or should remember, fiscal policy is the government's taxing and spending. And the goal with that is, if we look at the C plus I plus G plus X sub N equation, expansionary fiscal policy is intended to make this number go up, to make government go up. And then that will, in turn, make GDP go up. So monetary policy is different because it's not the government taking action. It is the Federal Reserve, and they engage in what's called monetary policy to improve this number, which will also make GDP go up. When it comes to fiscal policy, the government engages in taxing and spending, but with monetary policy, it is all about manipulating the money supply. They engage in a number of different actions in an effort to, if you remember this, make the supply of money increase and lower interest rates. Lowering interest rates would then cause investment to rise in our equation here, and GDP will rise. So, and it could also be, if you want, depending on what the College Board asks you to do, they may ask you to do a loanable funds graph. Either way, expansionary monetary policy will put money in banks and shift this out, lower interest rates. But if they ask you to do a money market graph, then you would do that and shift the supply of money outward because there is more money in circulation, and that gives us a lower nominal interest rate. So, how does the Federal Reserve engage in monetary policy? Well, there are three different mechanisms by which they engage in monetary policy. The first is what's called manipulating the reserve requirement. Okay, so that's one. Two is actually lowering or raising the discount rate. And three would be what's called open market operations. And what that is the buying and selling of bonds. Kidding me. So, buying and selling of bonds. That's going to be from the Federal Reserve. Buying bonds from banks would give the banks money to loan out. Selling bonds to banks will obviously take money away because the bank will have to pay money to get that bond, and there'll be less money in circulation. Okay, so that's kind of where we're at. So these are what we call the three tools of monetary policy. And I'm just going to go over each one of them briefly. And then we'll have separate videos on each of them. Or actually, this will be one and then this will be one. The reserve requirement is actually how much money banks have to keep in reserve. If we, let's see if I can find it. That's all right, I'll just make one. If we look at a balance sheet for a commercial bank, we have assets, liabilities, just a basic balance sheet. Let's say that we have reserves of 100 and demand deposits of 100. Nice and simple, nothing complicated. All right, the bank would like to loan out this $100, all of it. If they could, because they can charge interest on that. The problem is, if they do that, they have no what's called liquid assets. And whoever's money this is, whoever deposited this money, would, if they went to the bank to try to withdraw it, the bank doesn't have it. They just have these IOUs and loans. They don't have any money. They lend it all out. That's what causes a bank panic or a bank to fail, because this person will go tell all their friends that they went to this bank and couldn't get their money. Now, the logical person would think that would encourage people to say, well, they don't have my money, so I'm going to leave them alone until they get my money. But no, what it actually encourages everyone to do is run to the bank and try to get that money. So I go to my friend Steve and say, Steve, I went to this bank and they didn't have my money. Steve's going to go to the bank too and try to get his money, and the bank's not going to have his money either. And that's what's called a bank run or a panic, and that's when banks fail. So to combat that, the Federal Reserve, which is, it's important to note that the Federal Reserve is actually, it's a government organization, but it's not part of the federal government. The chair of the Federal Reserve is appointed by the president and confirmed by the Senate, but they are independent, kind of like a Supreme Court justice, where they don't run for office, they're not politicians, they're economists. The current one is Jerome Powell. Before him was Janet Yellen, and she was an econ professor at Stanford, I believe. I don't remember, but she was an econ professor in college. So anyway, they set the reserve requirement. They tell banks, listen, bank, if you have got, and we'll make a new one, if you have got $100 in demand deposits, in other words, that's other people's money, we expect at any given time for you to keep 25% of that. It doesn't have to be 25%. It could be 20, it could be 10, it could be 5, whatever. But what that means is this reserve requirement, and we'll put our or reserve ratio is sometimes called, means that this amount, you have to keep this percentage of this amount as reserves. You can loan out the rest, but you have to keep a certain amount. What that means is that when money gets deposited, that the bank can only loan out a portion of it. And if you remember, and we'll do this in a different video, but if you remember from your GDP multiplier, if I spend $1 and that person takes that dollar and only spends 75 cents of it, and then that person that they give it to only spends 75 cents of that dollar is going to have a multiplier of 4 because the, let's see, I have $1 and then I spend 75 cents of that. That means that this is the MPS and the MPC is 0.25, which makes the multiplier 4, and that'll turn this dollar into $4 of GDP. The same works here. If the bank gets, if the bank can loan out 75% of whatever deposit they get, that'll turn into a money multiplier of 4, change in the money supply. But that's a different video. Anyway, so what this would look like if they're following this rule is this would become loans of 75, and the reserves will become 25. Okay? That's what that means. That's what that turns into. And if they lower the reserve requirement from 25 to, say, 20%, then more money could be loaned out. But since that money is being created out of thin air, as you check the older video on balance sheets, but if that's happening, what's actually going on is we are expanding our money supply. Like so. There's more money in circulation, and nominal interest rates fall, which means GDP goes up, and just to tie it all together, if you remember this, SRAS, AD, LRS, price level, output. If we're increasing this, that's going to shift this to the right and restore full employment output. Okay? That would be what we call expansionary monetary policy. Which would be lowering the reserve requirement, lowering discount rates, which is the rate at which banks loan to these guys. So, for example, instead of messing with the reserve rate, the bank would just give a loan to this bank. So say they got, if I just make that happen here, they get a $100 loan from Fed, and then they'll have, $125 in reserves now. And they'll loan out that $100, creating $100 of money supply change. So that would be that. And lowering the rate at which the Fed loans to member banks makes it so banks will borrow more from them. And then the third is open market operations. That's buying and selling of bonds. We'll get to that in a different video. All right, so that's that for this one.